Do you have a high IQ? Well, good for you. But that won't make you an intelligent investor. According to Graham, a high IQ and an education is not necessarily what's needed to be a good investor. In fact, in '98, a hedge fund run by a battalion of mathematicians and computer scientists and 2 Nobel Prize winning economists lost more than 2 billion in a matter of weeks. The fund collapsed and they had borrowed so much money that they nearly capsized the entire system, showing that big brains don't equal big returns. What's up everybody, welcome to the channel, and if you're new here, on this channel we discuss valuable lessons that will be useful for the rest of your life, all based on valid sources, of course. Last week we discussed the basics of investing and what types of investments you can choose from based on the time you're willing to spend and the risk you're willing to take. If you haven't seen that video yet, I suggest you watch that first, as it will serve as a sort of framework for this video. In this video, we will continue on how to be an intelligent investor and what type of investor fits you personally. All right, let's begin. So if intelligence doesn't really matter if we succeed in the stock market, what does guy on the internet that seems to think he knows everything? Well, that's a good question, but please keep the attitude to a minimum. Most of the time, the people who have lost money in the stock market didn't lose money because they are stupid. It is because they haven't developed the emotional stability that successful investing requires. They simply didn't stick to their long-term plan and they let their emotions sway them by some article that a hipster wrote on BuzzFeed. And it's pretty hard to keep your emotions in check always. Sometimes your emotions are governed by fear, which makes you want to sell, and sometimes your emotions are governed by optimism or hope, which makes you want to buy. Now the trick is to never make a buy or sell decision in the moment. Always think about it for a few days or a week or a month. Because the company and the stock mostly stays the same, but your emotions change from moment to moment. So if you do this, it's much easier to have a clear long-term view of what to do with your stock. The second thing that is a must is that you must do full research on the company. And this means hours of your time. You must research the company earnings, the debt they have, the value of the company, the cash flow they have if something bad happens, and then you must make a decision. And this is the only way that you can make sure that you're looking at the company objectively and not just because you have a feeling or someone told you that the company is gonna do well. Depending on your traits and needs, you can choose to either be an active investor or a passive investor. It depends how much time and effort you're willing to put in and how much risk you're willing to take, and if you even fit the profile of an active investor. The active investor is looking to take the task upon himself, comparing companies, looking at quarterly results, and buying and selling the companies by himself. Now the active investor would run a little bit more risk, but might also get slightly higher returns, but not necessarily. The active investor will research his companies. Is the company undervalued? What's the industry gonna be like in 5 years? Does the company have a lot of debt? And if so, does it have enough cash flow to cover the debt in times of crises? Those are the sort of things that the active investor must investigate. It's a lot of work and most people don't have the stomach for it. But I think the viewers on this channel are not most people, are ya? Now the passive investor sits on his ass, automates his payments to his brokerage account and buys different types of mutual funds, essentially betting on the entire market. Now what I'm about to tell you might sound a bit frightening. On average, the passive investor, the guy who just spreads out his money between ETFs a little bit and does nothing, sits on his ass, does better statistically than the active investor, the guy who does all the research and handpicks his own stocks. I know it sounds weird, but unfortunately in most cases it's true. And there's more than enough science to back this up. But I would like to point out why I, for example, do like to pick my own stocks. First of all, it's obviously that you might do a little bit better. I'm pretty young, so I'm willing to take more risks. But also something that usually gets overlooked is that you learn so much. You learn about the government, you learn about companies, you learn about how the economy works, and that has value too, I think. I think that will transfer over in the rest of your life. Maybe, for example, if you want to start a company later on in your life, you will have all this knowledge that will make it so much easier. And I think that's something that gets overlooked by a lot of people when you take the lazy way out. It's not for everyone, of course. Some people don't like to think about money, don't like to look at numbers, don't like to figure that sort of stuff out. But I think it has some extra value, just throwing that out there. So take a good look at yourself and analyze if you're currently more suitable to be an active or a passive investor. You can always do a bit of both and see what works well. Next week we will continue with the last video in this series on how we actually handpick our own stocks. The method to the madness. Based on this book, The Intelligent Investor, of course. If you don't want to miss it, please subscribe. If you're interested in the book, there's a link down below. If you liked this video, if you thought it had some value, please like, comment and subscribe. And I'll see you next time. Thanks for watching.